After the release of Disney's 2017 fourth quarter results, the stock has been on an upswing. This is a big deal for the markets and for Disney shareholders because the stock has been in a rut for the past 2 years. Although Disney's 2017 fourth quarter results failed to meet or exceed analysts' expectations, investors were optimistic about Disney's future after getting more details about Disney's streaming service. Is the hope of what a Disney streaming service could become enough to have fixed Disney? First, we'll need to know why was Disney broken. Cord cutters and ESPN broke Disney. First, cord cutters. If you aren't aware, the term cord cutter is used to describe people or households that have stopped subscribing to cable or satellite. This chart shows cord cutter households as without pay TV households. Looking carefully at the second and fourth row of the chart, numbers of cord cutters continued to increase from 2012 to 2016. In 2017, it's expected that over 20 million US adults will cut the cord. Cord cutting is increasing. Now ESPN. Since peaking at 100 million subscribers in 2010-2011, ESPN subscriptions have steadily declined as people have walked away from cable and satellite television. Currently, ESPN has just under 90 million subscribers. In 2014, ESPN decided to re-up on their NBA deal and negotiated a new deal where ESPN pays the NBA $1.4 billion a year to air NBA games. This amount is 3 times more than the previous deal. This current deal lasted the 2024-2025 NBA season. We can only assume the hope was that the NBA would help to bring back subscribers, but it hasn't. ESPN, Disney, and the cord cutter. As cord cutting turned from an incident to a trend, Disney was late to react. Bob Iger, Disney's CEO, continued to be bullish on cable and would not spin off ESPN as a standalone app like many analysts thought they should. Using the NBA ESPN deal as an example, in 2015, if you wanted ESPN to watch the NBA but you didn't want to pay for the other 100 channels that came along with cable, you couldn't get one without the other. The cost at ESPN continued to rise as cable subscriptions continued to decline. With every quarterly report for Disney over the past 2 years, analysts continued to magnify the loss of ESPN subscribers and the channel's expenses, which would send the stock price falling. Simply put, Disney and ESPN didn't read the cord-cutting trend correctly and overpaid for the NBA, and it came back to bite them. Looking at the fourth quarter of 2017, on November 9th, the company reported its fourth quarter results, and despite missing expectations, the stock continued to rise in price. Why is the stock price rising after not meeting expectations? Because of expectations. Earlier this year, Disney announced that it would be removing its content from Netflix and starting its own streaming service. Disney plans to roll out its streaming service in 2019. Also, the company plans to launch ESPN Plus in 2018. Disney officials did not explain how ESPN Plus will work, if it'll be an app that a cord cutter can subscribe to like an HBO Now, or if it'll be an upgrade to the current ESPN app, which requires you to have a cable subscription. The expectation of the streaming services has caused investors to put their money into Disney. From the recent reaction of the stock price on the news of the streaming service, it appears Disney may be fixed in the eyes of some investors. What does the Seville report think? There's still too many questions surrounding the streaming service for us to believe that it can fix what's broken with Disney. How will the ESPN Plus app work? Will consumers be able to pay a monthly subscription for the app and watch ESPN on their phones, Apple TVs, Fire Sticks, and other devices? And for the Disney streaming service, what will be the ratio of adult content to children content? Disney has announced that it will develop a Star Wars series for the new streaming service. Will Star Wars and Marvel content be enough to get an adult to subscribe to Disney's streaming service? Also, how long does Disney foresee the streaming service taking to turn a profit? Bob Iger mentioned the cost of Disney's streaming service will be substantially below that of Netflix. Until we get answers to these questions, it's difficult to say Disney is fixed. The investors who have recently purchased Disney stock are getting it on the ground floor of the streaming service, with hopes that it becomes a success. The Seville report, on the other hand, will take a wait-and-see approach. Outside of what we've discussed, there are several other things going on with Disney, such as upgrades to the theme park, and Disney is currently in talks to buy some of the assets of 21st Century Fox. If the deal with 21st Century were to happen, Disney would be one step closer to reuniting all of the Marvel characters under one roof. Disney would likely get the rights to Avatar as well, which could be big in the long term. The titles that Fox would transfer to Disney would help Disney create a strong streaming service with lots of good content. Going forward, our alerts for Disney are ESPN Plus, the streaming service, and the Fox deal. As Disney releases more information about ESPN Plus, the streaming service, and the Fox deal, we can better assess how their plans will impact revenue and profit. Until then, we'll wait and see. If you're a believer that Disney's streaming service is the elixir needed to fix the company, then now is the time to buy. Although the company failed to meet analysts' fourth quarter expectations, investors were motivated to buy Disney because of where they feel the company is headed. Some of the best investments are made when a company is in its planning stages, and the best rewards are reaped when a good plan comes to fruition. fruition. I hope this helps you with your look into Disney as an investment. What do you think about Disney right now? Is now the time to invest? Do you think Disney's streaming service will be successful? Let us know what you think. Thank you for watching. If you want to get updates on what the Seville Report is doing, what companies we're researching, check out thesevillereport.com. Thanks for watching.